Good afternoon, everybody. Thank you for joining us on another edition of this client series of webinars that we've been doing here at Raintree Financial. My name is Adam Durgis. I'm one of the founding partners of Raintree Financial, and I'm here today with the one and only Gerald Tkach of the Millennium 3 group of companies. Thrilled to have you here, Gerald. So for everybody learning about this product for the first time, sorry about that. For everybody learning about this product for the first time, this is a very unique investment for a lot of reasons. It's a longer time frame than typically you'll see. There are some tax efficiencies within this strategy that I think are probably going to be pretty new to you. And also they boast a pretty wonderful track record that's, well, you'll see for yourself, but this is a group that has performed beautifully for their investors, not just from a tax perspective, but from a performance perspective. One of my mentors is a retired accountant, and one of his great lines is he always says, you never let the tax tail wag the investment dog, meaning you don't make an investment just because of the tax treatment. It needs to be a good investment here as well. So when you're learning about this investment today, I would challenge you to look at it from both perspectives, from that tax perspective, but also from the investment perspective itself. And I think what you're going to find is that it holds up very nicely from both angles. So Gerald, without further ado, I'm going to turn it over to you. For those on the line, what I'll ask you to do is when you're asking questions, please type them in the Q&A box in the bottom, not the chat box. The reason that I'm asking for that is that the Q&A box is a lot easier for me to keep organized. I can track which questions have been answered and which ones haven't. So we would encourage questions. Please ask as many as you'd like, but use the Q&A box when doing so. Gerald, over to you, man.
Awesome. Well, thank you everybody for tuning in, or those that are watching a recorded version of this later. Adam, I think you have to, do I just share my screen? There we go.
Yeah, there should be a button at the bottom there, Gerald.
Right. Perfect.
There you
All
go.
right. So hopefully, let me know if that shows you anything but what you want. What I'm going to do is I'm going to actually just stop my video. I was doing a presentation not that long ago, and my computer told me it was overloaded running both the video and the presentation. So I'll turn that back on for the Q&A, but for all intents and purposes, I'm just going to run the presentation. And if anybody has any kind of questions, thoughts, or comments, like Adam said, the Q&A is a perfect place for that to go. Yeah, we'll just start things off. So for the legal beagles, we always like to do a couple disclaimers. First and foremost is that there is some forward-looking information involved in the presentation. So what that means to us is, you know, we don't have a crystal ball, but we are kind of, you know, setting an expectation for a path of these investments into the future. So that is something that you have to keep in mind. The other piece is statutory rights. So again, if you do choose to go ahead with an investment in an offering that we have, you do have rights as the investor. So again, just feel free to review the official paperwork for those sorts of things. Now, I think there's 4 takeaways, whether it's a presentation like this that I'm hopefully going to keep at an hour or less, or I bump into somebody that I haven't seen in a while. They ask what I'm up to and kind of what Millennium 3 does once I mention where I'm working. I think there's 4 things that are important to what we do. The first is that it's commercial real estate. So we're not buying residential, although we do have a history in residential. I'll get into that a little bit later, but current investments are not residential. They're not hotels. We're not buying land and building commercial. We're buying existing commercial real estate, and we're owning it kind of like a rental property. The way most people own a rental property, it's, you know, a half duplex with their brother-in-law. They buy it, they fix it up a little bit. They have a tenant, the tenant pays the rent. They pay off the mortgage on the property, and one day it's debt-free, and they just kind of keep collecting checks. We're kind of doing a very similar business model, but it's larger scale commercial real estate. The second piece is that it's growth-oriented property. So we don't want to buy things that are beautiful, downtown, glass, everything perfect. What we're really wanting is the value add. So again, I make comparisons to residential. Here's another one. Those home and garden TV type shows where, you know, you buy it and you flip it. So you upgrade the kitchen and the bathroom, and that's where you make most of your money back, that kind of stuff. That's, again, kind of the model that we're doing, in that we're buying, we're going in and fixing where we think it can add value, but we're not selling. We're then keeping it and kind of deriving revenue from that. The final, or the next piece, I guess, is that it's the tax advantageous style of the investment. So the costs that go into that refurbishing and setting up the partnerships and whatnot, that can actually be written off by investors. So there's an interesting tax planning component of our investment. But as Adam said, piece number 4 here is that it's income producing. So what we are actually wanting to do is provide an income producing investment for you. So again, if you relate it back to that rental property, we want to get people excited about the income producing capacity of the investment. So whether it's preparing for retirement or just looking at building a combination of different investments that can provide revenue streams at different times and different pieces, we want investors that are interested in the income producing aspect of the investment. But of course, there are some risks. We want to cover that off as well. It's a going concern. So there's operation and leasing risks. So there's leases to maintain. We have to secure new leases in places that there's available bays. There's management and refurbishment work that goes done. So again, it's just it's a going concern. There's always things that are happening in these properties, and sometimes it works, and sometimes it doesn't, and that's sort of the nature of that. And when things don't work, it doesn't mean that it's bad. It's just not everybody leases from us that inquires, so to speak, right? Long hold period. So this again is something that we're not shy about. We are a long-term investment. So again, the mortgages on these properties pay out over a long period of time, much like that rental property. So we want people to understand the long-term time horizon of the investment and that there's no specific redemption mechanism. Now there is ability for projects to sell. It's just, it's not defined that, this year exactly is when we actually go ahead and sell. We have had properties that have sold. I'll hopefully get to that at the end of the presentation. But there's no line in the sand that says officially everybody exits at this date. It's really being held for the tax deduction up front and the long-term income at the back end. And if the project sells in between or at any point in time, it's the choice of the investors. It's not forced. The final piece is that it's a local market. So again, the particular investment that I'll show you a little bit later today is in Regina, Saskatchewan. Go Riders. But it's one of those where for good or for bad, things that happen in that economy might not affect a property in a different economy. So again, keep in mind we're discussing this on the risk side, but that is on the benefit side as well. There could be good things in the Regina market that benefit properties that wouldn't benefit other economies. So Millennium's timeline, we started in Saskatoon in 1981. So I had mentioned that we have a history in residential. This is actually where it started. The first 7 years of the company were multiple unit residential buildings. So again, it was kind of 24 suite, 54 suite apartments, that sort of thing. But it still had a similar investment kind of idea in mind. Is that big institutions seem to own all the big real estate in town. Why can't the average person participate? So it was kind of a collection of investors that got things together and owned apartments together. In Saskatoon, the apartment market got a little bit overbuilt. So when the opportunity came to look into commercial real estate, the owners of the company pursued that, and that's been our history for the last 30 plus years. So it really changed our focus to commercial in that it provided advantages that we felt helped smooth out the investment cycle, smoothed out the revenue stream, and made it a little bit more advantageous, right? But those original residential and commercial properties all had a 25-year mortgage amortization. It was really about maximizing the mortgage leverage and minimizing the amount of investment capital that was needed up front. Now, because of that, investors came to us and, over the years, it kind of said, geez, I'm getting older. I wish I could have started this when I was younger. And of course, you can never go back unless anybody, has a time machine laying around. You can't get that time back. So what can we do to get to the mortgage debt-free time period quicker, right? Because if you think of retirement, let's just say 65, it's a 25-year mortgage. You really need to be investing in these things around 40 was the idea at the time. Now, investors in their 50s would say, really interesting, but geez, that's 25 years. So we looked at shortening the mortgage life to between 10 and 15 years in 1995. And again, that's been the model ever since. So now we're really focusing on getting the mortgage paid down as quickly as possible, foregoing most of the revenue in the early years and just dedicating it directly to the mortgage. But we now get them paid out a lot quicker. Final piece is that we began acquiring property in Alberta in 2005. So we own properties both in Alberta and Saskatchewan, Western Canadian, about 2/3 in Saskatchewan, 1/3 in Alberta. So the benefits of commercial real estate investment is that the value is based on the location, utility, and the income from long-term leases. So the main driver of that is the income from the leases, right? So we want to buy that fixer-upper property where we can go in and effectively increase the lease rates for the tenants in one of two ways. We're either fixing out the outside, prettying the building, and again, all else being equal, a good-looking property rents out for a higher amount than a less good-looking property, or the other side of it is investing in those spaces, kind of the example again of doing the kitchen and the bathroom renovations in residential. Well, a lot of times you can go in, you're the new landlord, tenants want to get to know you, but at the same time, they have this kind of wish list of things that they always wish had got done, but they don't have the time or necessarily the capital to do it, but you as a landlord maybe do, right? So, you know, our example of that is you might go into a space and somebody wants a second office built and another bathroom in the back. Okay, well, we'll, you know, they're maybe an accounting firm. They don't have the time to do that or whatever the case is. We can go in with our construction team, go in, do that work, spend the money to do it. Let's just say it's $25,000, $30,000, whatever it is. But then we can amortize that over the course of their lease. So for in that example, you know, somebody who's got $10 per square foot rental rate, perhaps we, you know, do the work when their lease comes up for renewal. We say, okay, because of that work, how do you feel about paying $12 per square foot? And they say, you know what? Yeah, we can handle that. Sure, that works out well. It's kind of a win-win. They get the things that they want. They don't have to put up the capital to do it or the, you know, the knowledge to do it. We take our capital and our knowledge, we do the work, but then we're getting a 20% increase in their particular rental rate, right? So now you start to extrapolate that over other spaces in the building. We can increase the total income coming in by maybe 10 or 15%, right? That, of course, will increase the value, all else being equal. That increase in income coming in from the tenants is increasing the value for investors. But of course, if it was all easy and fantastic, everyone would be doing it. Why aren't we doing it already? First and foremost is often the large capital required. So it usually makes it available to wealthy individuals, funds, and corporations. And that really just gets into the cost of a property. You know, your average small neighborhood retail property, maybe, you know, 6 to 10 tenants, is, let's just say, maybe $4 million, right? So, you know, that's a pretty big chunk of change. And a conventional mortgage on a property like that maxes out typically at about 75%. So for that $4 million property, you have to have $1 million cash to close, plus your costs of due diligence of making sure it's a good property, right? So for some people, $1 million plus is a lot of eggs in one basket. They might not be comfortable doing that. And some people, it's just completely out of their kind of individual reach, right? So the idea is that we're kind of, you know, bringing an investment, and you can't own the whole building, but maybe you can own a small piece of it. The second piece of the barriers to entry is that $3 million mortgage. Say you are lucky enough to have the $1 million kind of that you can work with. Getting a $3 million mortgage is not easy as getting a residential mortgage, right? They want to make sure that if you lose a tenant, how are you going to make sure that you can make your mortgage payment every month if you don't have the income coming in from these tenants, right? So there's all sorts of you know, contingency planning and stuff like that that the bank wants to put somebody through to make sure they can get that size of a mortgage. The final piece is it requires market knowledge and industry connections, and it can be management can be time consuming and requires specialized knowledge. So again, a good example of this, maybe I didn't point it out yet in this part of the presentation, the original residential properties that we had, we still held many of them for 30 plus years. Like the large bulk of them sold off in the late 2000s, early 2010s, as there was kind of a real estate boom in Saskatoon for that sort of condo conversion type of real estate. So we have a 30-year history with a lot of residential you know, pieces. So our residential leases were 2, maybe 3 pages, kind of really outlined who's doing what and who's checking fire alarms, that kind of stuff. Our commercial leases are 20 to 30 pages, right? They're a lot more consuming. They're a lot more significant. You know, in a lot of cases, we actually even have personal guarantees on that lease. So if you start a business and you sign a 5-year lease with us, and after a year you go, yeah, it didn't really work very well, I'm just going to pack it in and close up shop and turn the keys back and walk away. Well, thank you very much for the keys, but that's not over. Like, you were still responsible to pay for the next 4 years of leasing whether you use that space or not. And again, if you have a personal guarantee on that, like it can extend to your personal asset. So it's a much more significant covenant than just kind of a residential lease that, a month or two, you get people that kind of walk away from leases all the time, and you honestly feel that the cost of chasing them to get your couple months worth of rent is probably the couple months worth of rent, so you don't even bother, right? So that's kind of, some of the pieces that it's not easy necessarily to know all the different, individual pieces of commercial real estate, many of which we think is advantageous to the landlord, and that's why we want to do it. But there's a big learning curve, especially if you're trying to extend from residential to commercial. So our solution is to partner. We enable investors to participate in the benefits of commercial real estate through collective ownership. So utilize our knowledge and our connections and come in partnership with us in these properties. So smaller investors can buy in and be a commercial real estate owner. The limited partnership structure means limited risk. So there's no recourse to investors and no liability. The limited partners share in the revenue produced by the property and the ownership. So I did mention again that some of these properties do sell, and when they do, it's shared amongst the partners, right? So if you bought into a property and you just happen to be 1/100th owner, you own 1%, the property sells, you get 1% of the proceeds, right? So it is really that kind of ownership. It's structured through a limited partnership, but you are a proportionate owner in these investments. So we use our connections and expertise to find properties with that high growth potential. So what we're looking for is typically a combination of these three things: a strategic location, lower price reflected by below market rents, or a motivated vendor. The strategic location kind of, the location speaks for itself, but a lot of people think of that in the residential, or not residential necessarily, but the retail construct. So, your strip malls that have your pizza and your Dairy Queen and things like that, you want it on a main drag where people can see you, right? The same location applies to perhaps industrial, but you want different things. You don't necessarily want to be on a main drag. If you're involved with semis and things like that need to back into your space, you don't want to stop traffic every time you've got a semi that needs to kind of get into its base. So, things that are important in industrial are different than retail. It might be access to major roadways or dock and grade loading or things like that. So it's, important to know those sorts of pieces for what you're actually looking for in properties. Lower price reflected by below market rents. This kind of speaks to that example that I'd said about, going in at $10, you're buying it there, but you're increasing the value to $12 kind of per square foot. We want properties where maybe the previous owner let it get neglected a little bit, wasn't so pushy about increasing rents for tenants, just kind of, you always let them win those negotiations. We deal with 500 commercial tenants on an annual basis. We have no problem getting market rates. If people want to say, hey, that, the rate you're proposing is too high for me, well, everything's a negotiation, don't get me wrong, but if they truly can't pay what the going rates are in that marketplace, we will say that's unfortunate, but maybe we can show you something in a different part of our portfolio, in a different property that is more to your, financial ability, and we'll find somebody new for that particular space. So we have no problem kind of moving tenants in and out and kind of working on those negotiations, but we definitely like the stuff that somebody else has not spent the time or money on. We can go in, do that work, increase value for investors. The final piece is just sometimes a motivated vendor being at the right place at the right time. Pardon me. This has often benefited our investors to the tune of, multiple hundreds of thousands of dollars, just being able to act on a good deal, get the deal on paper. It's the days of shaking hands are kind of a little bit over, but that kind of idea that we've got the deal done, everybody stops looking for kind of better rates or terms or whatever the case is once you get the deal in place that works for everyone. So we're known to be a closer when it comes to properties that we like and that work for us, because we know exactly what we're looking for. It does not take long for us to figure out if a property will work for us. We get it locked up, we go through due diligence, make sure everything kind of checks out, and if it's good, we bring it to our investors. So what we actually do is we go ahead, purchase a property, secure the financing, establish a limited partnership, and act as the general partner to that partnership. So there's 4 steps that are already involved here before investors ever come in. So that is one of the things that a number of investors appreciate about what we do is exactly what you're buying. It's not a blind pool. I will talk about the Millennium 3 business model because it is really consistent from project to project that we do, but it's not like I'm just saying, here's what we'll do. please invest, and later we'll tell you what we ended up buying. You know exactly what you're buying with our limited partnerships, whether it's an industrial property, a retail property, who the tenants are. You know exactly how it is because we've already gone ahead and purchased that property, got everything lined up, and then we bring in partners afterwards. So the interim financing, cash flow coverage, all that kind of stuff is taken care of as part of Millennium's piece of what we're bringing to the table effectively. The long-term management. So we are a long-term investment. I kind of talked about mortgage terms a little bit briefly earlier. We're a long-term investment. We're not shy about it. We just look at it from portfolio planning. It's not just about being diversified in kind of public markets and private markets, but you should also kind of have a look on short-term, medium-term, and long-term investing, right? Sometimes long-term investments have particular features that you can't get in short-term or medium-term investments, and that's part of what we feel that Millennium brings to the table. There are a few challenges and hiccups of kind of mental things that you have to get over, like the long-term, but the income should not be able to get if you're just kind of looking at short-term opportunities. So with our long-term opportunities, we provide both long-term property and asset management. So again, the idea is that we are here to increase the value for our investors. That's all. The only people that we're working for are our investors. We're not working for anybody else, but it's really about just achieving that best possible return. But it's both property and asset management. So we deal with the tenants, but we also deal with the surrogate ownership duties, the tax reporting to investors, the reporting, the mortgage work, the property taxes, all that kind of stuff is done by our group. The final piece is the property refurbishment. So again, when we go in and we look at a property and we say, okay, we think it needs this, we think it needs that, that's also taken care of as part of these offerings. We go in, get that work done, and again, the goal is, of course, to enhance the leasing potential of the properties. And that's what brings about the tax advantages. So investors get to write off partnership setup and refurbishment costs directly against other taxable income. So I will get into a kind of examples of this and kind of a little bit more discussion a little bit later in the presentation. But that's the idea. Again, if you relate it back to residential, say you own a rental property and you paint it and you build a deck and you do this, that, and the other thing, typically you're keeping those receipts and then you're writing them off against your personal income, or at least the income that the revenue property produces. This is kind of a similar, it's definitely different aspects of the Income Tax Act and whatnot, but a similar type of feeling in that when you're going in and kind of, working on spending money on the property, it can become tax deductible. It's not something that, again, is really easy to do or easy to figure out for a first time person picking up the Income Tax Act. But that's the benefit of us having done this for almost 40 years. We really do know what we're doing. We know how to write it off. We know what can be deducted and what can't, and that's kind of the benefit that you get when working with Millennium 3. So our experience, we currently maintain 68 commercial properties. We're one of the largest commercial landlords in Saskatoon. Got 24 completed projects in the Alberta area, generally focused around the greater Edmonton area, and about 325 million of assets under management. So again, if you're comparing us to a publicly traded REIT, a real estate investment trust, we're a small one, but that's the idea, is that it's been slow, stable growth to build to that kind of point, $1/3 of $1 billion. There's definitely people bigger than us, and that's fine. Ours has just been slow, stable growth, doing a couple offerings per year, a couple properties that we bring to investors on an annual basis, part of their tax planning, part of their investment planning, and possibly even their retirement planning. So that's kind of where we fit on an annual basis, as well as our total pool. Now, just examples of types of properties that we do. This is what we would consider a retail offering. It's got a gas bar, a cleaner, or like a dry cleaner, a couple medical uses, a restaurant or two. So this is what we consider retail. This would be an office property. It does have retail on the main floor, but the second floor as well. When you say insurance, they're kind of an office use. They have the majority of that space. And industrial. Industrial, I don't know if I've already called it this, but I often call it a hidden gem, is because they don't look great. This isn't a typical industrial property. Some of the tenants don't even have sign cans to tell you who's there or what they're doing, because that's not important to them. If you need their service, in a lot of cases, where you're going to get there, right? It's the idea is that some of these are logistics companies. We've had tenants that have moved in maybe 5-10 years and still not put up any signage because it just is not important to them. If you know that you need to go there, to go there, and that's all they care about. So, there's not every tenant's like that. Most tenants want a little bit of signage or something like that, but different important factors for different people. And in industrial, it's often just the space that they need. And as long as you're good to them and they have the space that they need, whether they need a high roof or a low roof or a lock, low loading is a certain type, Docker grade. Those are the things that are important for industrial tenants. So if you have buildings that are kind of provide that and they're flexible, you can move things around. That's what industrial tenants often need. So our investors, 1,500 strong that we've accumulated over the years. That's active investors. They own 5,500 limited partnership units. So there have been units that have sold along the way, but that's the kind of active pool. Now, if you do the kind of quick math on that, it's a little under 4 per person. Everybody has their own kind of reasonable amount and suitable amount. So again, you do have to work with the dealing representative to kind of figure out that. But what we've seen over the years is a multitude of different investor styles. Some people are using this for regular tax planning, buying in a unit or two year after year after year. Some people are working backwards to kind of build a passive income, and the tax deduction is the bonus. And again, I'll touch on those factors a little bit later. But the idea is that everybody has their own amount that makes sense. For some people, it's one. That's all they ever buy, and that's fantastic. Our largest investor is near 100. So, it is one of those where everybody's situation is different. But working with your dealing representative, you can help kind of figure out what might make sense for you. Over 50% of our investors are repeat investors. Now, what I do like to point out about this is that actually stretches over the 39 years. So we've looked at the entire pool now. A $25,000 investment was a lot bigger portion of somebody's investment portfolio in the early 80s. So there was a lot more of those kind of one-time investors that never really invested again, because that was just a larger, that was a bigger chunk of their total investment portfolio. What we found is the number is actually a lot higher if we look at the last 5 years. So that's exactly what I did. And I looked at all the investments we did 5 years ago. And I said, is this somebody's second or more investment with us? So again, that the investment that they're making in that 5 year ago period is, their second, third, eighth investment with us. Or if they're a first time investor, did they invest again in the next 5 years? And 83% of those investors did invest again, or it was not their first investment with us. So, if we looked at a really smaller, more focused sample size of the last 5 years, it's about 83%. So keep that in mind, and that maybe, for your personal scenario, 6 of these might make sense for what your investment goals are, or with tax and investment planning. Some investors do want to come in and just say, yeah, I'll take, 6 of this current offering. I like it so much, let's do it. Most of our investors do want to diversify and spread that around a little bit. So maybe they buy 1 or 2 units a year for, 2 to 6 years, right? So, or 2 or 3. But that's kind of your own choice. And again, working with a dealing representative to know how much diversification is important for your personal portfolio. There's a vested interest of the principals of the company, so we like to point that out, is that they buy units in every limited partnership. So that does align things with management and the investors, in that their money is right on the table next to yours. I go into my boss's offices every year, a couple times a year, and say, okay, it's time for you to make your purchases, break out your checkbook, they write a check. There's no commission on those units, there's no kickbacks, there's no free units, nothing like that. They write checks for $24,700, just like every single investor does. So again, I don't know if I've mentioned the purchase price at this point in the presentation, but that's the purchase price is $24,700, and I will touch on those numbers coming up here very shortly. First, I want to touch on the corporate guidance of the company, because I think this is something that we really bring something to the table that maybe not a lot of other groups can provide. And it's not just kind of the leadership from the top, but it's the total team and kind of the involvement in the organization. So now, first starting with the umbrella management, the Kearley family. Everett Kearley founded the company. He's still active in the office kind of 2-3 days a week. He's chairman of the board. He's in his early 80s. He's an old Army guy, active in mind, body, and spirit. But again, he's found that job that's not a job, so he keeps doing it. But it is really in an advisory kind of fashion. He's not usually involved in the day-to-day of kind of the organization. Now, the day-to-day is taken care of by John Kearley. He is the president of the company. And the common last name, John, is his son. Now, what I like about this kind of relationship is John has been with the company in a full-time capacity for 26 years. So this isn't an instance where Everett wanted to retire at Thanksgiving dinner, just John happened to be sitting next to him, and that was enough to kind of get, be told, here you go, here's a company for you, go try and run it. John has worked his way up. He started in the construction division, ended up managing that division, working in higher and higher roles in the company, and just kind of figuring out what we do and how we do it. Those things were done many years ago, right? So John is certainly cut from the same cloth as Everett, but the two provide the umbrella management to the overall organization. Now, there's 4 main divisions that all have a vice president. And this, again, I think to me is where that unique piece starts to kind of slide in. It's not just a really consistent message, a really consistent team from the overarching kind of Kearley family. Within the vice president level, there's a lot of consistency. So Alan Lebjak is the CPA CMA. He's our VP of Accounting Services. Alan has been with Millennium for 27 years. So you've heard that correctly. Been with Millennium for 27 years. So that's not 27 years of being an accountant or 27 years of, 5 different jobs. He's been with Millennium for 27 years. So if you want to know about limited partnership taxation, how our stuff works in the Income Tax Act, all that kind of stuff, Alan is your guy. He handles all of our tax reporting to investors. And again, if anybody knows this kind of stuff inside and out, I've been in his office when Revenue Canada has called him asking questions. That doesn't by any means mean that we write our own ticket. They look at us just as much as anybody else, but that's that kind of idea where if you want an expert in your office, Alan is certainly that expert. Mike Lalbury is our VP of Operations, 42 years of industry experience, 17 of which with Millennium. So again, Mike is the one person where I will mention his industry experience. And when you do that kind of quick math there, he's been with Millennium for the last 17 years. So on its own, fantastic. But if you take his 42 years of industry experience, subtract off his 17 with Millennium, you're left with 25 years. Well, that other 25 years was with one other company in Saskatoon that similarly owned residential and commercial real estate. And he worked with them for 25 years before we were able to bring him over to our team. So Mike's had 2 jobs over his career, 42 years. Again, this is the guy that he knows every game a tenant's going to play before they play it themselves. With just that many years of experience doing this exact same thing, he knows everything that's going to happen kind of 3 steps ahead. So he's fantastic working on our side in that kind of lease negotiation setup. I'm a vice president. I've been with the company for 18 years. So again, if anybody caught the video really quickly at the head at the beginning, I'm a relatively young guy. I've been with the company for 18 years. I'm 38 now, so I started when I was about 20. Now I didn't start at vice president by any means. I worked my way up over a number of years, but it's been a fantastic ride. But I also really enjoy what I do. I talk for a living. Current circumstances kind of taken off the table a little bit. I go for lunch. There's sometimes some golf. I really enjoy what I do. I feel like an educator in a lot of ways because what Millennium does is unique. For some people it works, for some people it doesn't. No hard feelings. You kind of have to decide whether it works for you or not. I'll explain things as well as I can. I'll answer any questions, but that's really all I do. I'm not really kind of pressured to go out and have a quota and sell this many or anything like that. That's not Millennium. That's not what Millennium wants to do as an organization. So similarly, I don't have to do that, right? I spend time with people, kind of teaching them about what Millennium does, what it might bring to their investment portfolio for both tax and kind of investment planning, but it's their choice. So for that reason, I've been with the company for 18 years. I certainly can see a world where I'm here for another 18, 20, 30 years. I don't have kind of interest in kind of always looking for something a little bit better and a little bit better. When I'm happy with something and treated well, I'm going to stick there and I'm going to be committed to them as much as they are committed to me. And I really feel that in this organization. Jarvis Ryan is our final vice president. He's been with us for 17 years. He's VP of Finance. He handles all the offering memorandums, mortgages, that kind of stuff. But again, even when you take out the Kearley family, you take those 4 vice presidents and they average almost 20 years with Millennium 3. So there's a lot of pieces there that's a consistent message over the years. If you bought an investment 15 years ago and you're having questions about it then, and now you have questions about it now, I'm probably the person still answering it, right? And similarly, if you buy an investment now, I'll probably be there 15 years from now answering questions for you down the line. So we do really want to provide, we know we have a long-term investment. We want to make sure we provide a long-term management team as well. And I think you can see that here in our team is it's by no means a revolving door, and there is strength in that kind of unity. There is an independent director, so it's always good to point that out, as it's not just kind of Millennium doing what Millennium wants to do for years and years and years. There's an independent director that kind of keeps an eye on making sure that we do what we say we're going to do. That gentleman's name is Daniel Bollinger. He's a CPA, CMA, and is Director of Financial Services for Saskwater. That's one of our Crown Corps here in Saskatchewan. He's got about 20 years experience in both the public and private sector. So again, good person to understand what we do, how we do it, and make sure that we kind of carry out that. So now getting into the investment features. So this is where I will talk about the Millennium 3 model. We'll talk about the investment specifics a little bit further into the presentation, but Millennium kind of breaks down into 4 things. So the earlier kind of takeaways of, commercial real estate, growth-oriented, tax advantage, income producing, that's one thing. But now there's 4 points that I'm about to make. If you memorize those 4 points, you now know what the current investment looks like. You know what the next 5 investments look like, and you probably know what the last 5 investments look like, because they're all structured to work in this consistent model. So once you learn what we do once, it's really easy to decide if you want to do it again, because at that point, the financial structure is the same. It's just the property, the location, those, who the tenants are might be the different pieces. And to be honest, that's typically, 20% of the decision. 80% is really the financial structure and does this work for your financial goals. So the cost of each investment is $24,700. The first year tax deduction is about $12,000. So you buy it in 2020, you get about a $12,000 tax deduction. So if, for example, you had a $162,000 income, you bought it, it reduces your income to $150,000 of income. So again, I've cherry picked a really easy example there on the math, but at any level of income, whether it's $250,000 or $100,000, this is going to lower your taxable income by about $12,000. Now, the mortgage on the property typically pays out in about 14 years. So again, that's how long it's going to take, where the money coming in from the tenants is paying off the mortgage. But of course, Gerald, what happens in between? Well, there's a little bit of cash flow that goes to investors, but it's a few $100s a year. If everything's going according to plan, it's about $400 a year that typically goes to investors. And again, that is in those mortgage years of 1 to 14. Now, the exciting part of the investment, or again, another exciting part of the investment, because often the tax advantage is exciting for a lot of people, is when the mortgage pays out. Then what it looks like once we kind of get all the pieces in place, get all the bills paid, in that 15th year, now we're starting to produce about $5,000 of rental revenue annually per unit. So that's per unit per year. So if everything goes according to plan, $5,000 come in, you pay the bills, everything else goes out to investors. The next year, same money comes in, maybe a little bit more, pay the bills, everything else goes out to the investors. By maybe year 17 or 18, maybe that number's grown to 5,500. You pay the bills, you pay everything out to investors. So that's the kind of idea there, is that our income streams also do on some level kind of hedge with inflation. So the goal is to get them to about $5,000 when the project mortgage pays out after about that 14, 15 year timeline. But by year 20, 25, 30, we should be looking at higher and higher amounts. So that is what, on the income production kind of long-term ownership of these investments, that is what a lot of people appreciate about what we do, is the income streams are typically hedging inflation. So as the economies are growing, inflation is growing, we're not kind of losing that purchasing power to just the inflation kind of bug. So the current offering now is called the Industrial Group 5. It's offered as Cartwright Properties 2 Limited Partnership. I'll explain the Roman numeral 2 very shortly. It has no connection to Millennium 3. That's a whole other story that I'll save for another day. The 2 has to do with the fact that we started this offering at the end of 2019. So it started, I believe, in late November. Between late November and the end of December, we sold 49 units. So investors in those partnerships got their tax deduction for 2019. So for anybody, you can't go back in time. You can't fix last year's taxes by buying a property the following year. So the remaining 49 units are available in 2020. Will come with a 2020 tax deduction, but the two partnerships together will own the property. So no matter which partnership you got into, if you bought one of the properties or one of the units, you own 1/95th of that property or the collection of the properties, right? So that's your proportionate ownership. So there's no one partnership outvotes the other or anything like that. There's a co-ownership agreement that connects the two. So it's always kind of acting together as if it is one partnership. Now, the principals and vice presidents are purchasing 7 of these units. It's important that's that kind of vested interest. They're investing almost $200,000 of their own capital into this property. Again, it's actually a sizable number, but then keep in mind, again, we've done 60 some of these, and they invest in every one in kind of a similar capacity. So the fact that almost $200,000 is going into this offering, but there's varying ranges of $200,000, $300,000, $400,000, $500,000 that go into other offerings, but it's always kind of proportional. Now, they can't buy more than 10% of any offering. So it is kind of typically between that 7 and 10%. So they never have a controlling interest, but they do have a vested interest. So it's something I like to point out. Now, it is available for only non-registered funds. So if you have RRSPs, TFSAs, hopefully your dealing representative can help you find investments for those registered accounts, but we are only non-registered accounts. Now, specifics of the property, properties, I should say, 2 properties, collectively about 38,000 square feet. Roughly each of them just a little bit under 20,000. St. Charles building and the Hamilton building are what we call them. Industrial tenants, and 100% occupied. So again, that is not necessarily a requirement of a Millennium 3 offering. We often, again, in that added value, we like to buy properties that have some vacancy. So typically 70% occupancy and higher is where we want to go. This particular property just happens to start with 100% occupancy, so it's by no means a bad thing. There's still work to be done at the property and whatnot. So it's just kind of a little bit extra minor bonus that some of the work is already, of getting new tenants doesn't need to be done. But now it is about retaining and kind of working with tenants that are already there. So for anybody who knows Regina, again, this is their Ring Road, just a couple properties up here in the northeast. The Google Maps, so you can see they're not kind of neighbors, but they are just up the street from each other. So that's where the 2 buildings are, just a couple blocks away from each other. And for those who want a little bit more information on the location, it's the Ross Industrial Neighborhood, Industrial Park, I should say, in Northeast Regina. It's a well-established neighborhood of light and heavy industrial uses. So it's got a mix of both. It's an older neighborhood, and that's well-established. 30 years it's been there, so it's not kind of new, and it's trying to attract new tenants and things like that. There are other industrial yards in that sort of capacity. So ours is kind of the thing that's been there for 30 plus years, and that's, for us, that's what we like. It provides easy access to Regina's main transportation arteries and beyond. But the main piece of what we like about this location is the low vacancy rates versus the high market lease rates. So you have to look at that supply and demand perspective. And as of early 2020, Regina had a occupancy of about 95% for this particular industrial neighborhood. So that means that of all the available space, 95% of it is filled. So, and then it speaks kind of almost perfectly to our investment, it's 100% occupied. So if you do end up kind of having a tenant move out of the space, well, when 95% of the spaces are taken, anybody new that wants to come in, your available space is kind of probably higher on the list because there's just not a lot available. But the other key of what that does is that lets you push your rental rates higher and higher and higher when tenants are renewing or new tenants are coming to the space. It's just the perfect supply and demand matrix that we like to see for these types of investments. If you want to know a little bit about the tenants, I think I have 2 or 3 that I converse about here really quick. Prime Fasteners, they have been servicing the construction industry for about 50 years. They're the largest distributor of nailing and stapling construction products in the country. So for me, when I want to do a little baseboard renovation at my house, which I thought I would take on during the kind of pandemic time, which didn't actually work out very well because it turns out my 2.5-year-old is just as much of a full-time job. I would go to Home Depot. That's where I'd get my tools. I use it a couple times a year and life goes on. If I'm doing it for a living, this is where I go. So people in the construction industry, this is where they go, just better quality stuff that's designed and made for almost consistent, constant use. So the other piece of this particular tenant that we like is they're a tenant of ours in a space in Saskatoon. So we've actually had a decade-long experience with this tenant. They've always been good. They've always paid their rent on time. So to have them as an anchor in this new property in Regina is fantastic for us because we know they're not going to try to pull a fast one on us. Their word is going to be true. If they say they're going to renew, they are. We can trust their word given the relationship we already have with them. Amando's Pita is another one, just more of kind of an interesting, little bit of a story. They supply pitas to Extreme Pita, Pita Pit, 7-Eleven. They also have some Lebanese food. So they have, a few thousand square feet of space in the property. Just looking that up, about 6,000. So what is kind of, interesting about this type of tenant is they have the space that they need, right? So if you think of back to kind of my childhood a little bit, that game called Mousetrap. It's kind of this board game where, you know, you drop a ball and it rolls around a bunch of different kind of obstacles and it ends up kind of catching mouse at the end. But it's just kind of, you know, how it rolls around the whole board and comes full circle to end up kind of catching this whole thing. The pitas on what that they make here, they come out of an oven, they go on this conveyor system that's kind of, that mazes around the space in the back. But what's unique about that is that by the time they get to the end of the conveyor system, they're cool enough to be packed. So a tenant like this, you know, you would think maybe on a layman kind of the way I would start thinking about this is just like, you know, they take them out of the oven, they throw them in a bag, they, you know, put a twist tie on it, and they send them out. Well, that's not actually how it works. They need a lot more space, and it has to do with the cooling and kind of the, you know, that sort of the cooling in the packaging. So, you know, they need more square footage than maybe the average bakery does. Other tenants in the space, Teach Oil Transport, Grows Trucking, so a couple of trucking companies there, Emerald Water and Ice, Four Corners Roofing, Marathon Mechanical, Deluxe Meats. You know, tenants that you may not recognize those names. Even if you're from Regina, you might not recognize those names, but that's common in industrial usages. You know, these are tenants that might have, you know, 10, 15, 20 years of kind of leasing for their business. It might transfer from father to son, like, you know, every story, every business has a story. They might lease for very long periods of time, but you might never have heard of their names, but you can probably figure out what they do, right? Roofing company, mechanical does probably heating, ventilation, air conditioning. Deluxe Meats is a meat distributor. Trucking companies are trucking companies. So very, very normal uses for industrial building. Now, specifics of this offering, as I mentioned, the kind of structure versus the specifics. Here's now the specifics of this offering. So if you invest in our current offering, the Cartwright Properties 2 Limited Partnership, it's going to cost you $24,700. Now, the first year tax deduction is about $12,980. It's a little bit higher. It has to do with it being that kind of second year of the offering. Now, what I do tell people is if you are thinking of making this investment, still budget for about a $12,000 tax deduction. The reason is there will be 2020 operating income that's going to offset that deduction a little bit, right? So I would say, again, if I was the person buying this unit, I would budget $12,000 as my tax deduction. It might be a little bit higher, might be a little bit lower, but there's going to be some offsetting income to that deduction. It's kind of a gross versus net situation, but it's usually not more than that amount. So 12 should be safe. We project that the product should be able to pay out its mortgage in about 14 years. And again, it has that same anticipated $5,000 of rental revenue per unit per year once we get the mortgage debt paid off. Now, I've mentioned a couple times just kind of in my own personal life and things like that, like COVID and how things are kind of working for this particular investment. So I kind of speak about it in two different ways. One is our portfolio, one is this particular offering. So within our portfolio, we've had extensive conversations with everybody down at Raintree of how it's gone for us. We've had a long partnership together, and I think that everybody's kind of, you know, got their head around how it works and why it works that way. So we were reasonably pleased with our rent collection during the kind of last 3 or 4 months of COVID. Rent collection started out again when things were just kind of hitting and businesses were closing at about 80%. It's grown to the very last month of rent collection was about 96% compared to pre-COVID levels. So we are very pleased that we've been able to kind of start collecting those almost pre-COVID levels, because even pre-COVID, there's still, you know, 5% of rent that you're always kind of chasing tenants for and trying to get. So we're kind of at that point. And in fact, in August, we're expecting to potentially collect over 100% of rent, and it has to do with tenant deferrals. So I'll get to that a little bit shortly down the line here. But with regard to this particular property, all tenants are still a going concern. So nobody's kind of packed it up and closed down and shut their doors and kind of gone away. And 7 of the 8 tenants are still paying rent and have the whole period of time. One tenant is having some challenges. So we're looking into government programs to kind of help them weather the storm, because for us, the biggest thing that can go wrong is tenants go out of business. That's what we don't want. So our intent is to work with all tenants that require assistance, and there's multiple stages and plans that we can do that with. There's government funding, there's a CECRA program, which I apologize I don't remember the acronym for, but it's fairly commonly known as the one where the government pays a portion of your rent. 25 is the tenant, 25 is federal government, 25 provincial government, and 25 the landlord essentially just doesn't collect. That's a program that in some cases we are willing to go through with tenants if it helps them survive. What's been more common is tenant deferrals. So it's where tenants say, I'm challenged, I'm having some struggles, but I don't qualify for any of these government programs because, you know, my revenue is only down 50%, but the hurdle rate is 70%. So we say, okay, we understand. How about this? You pay half your rent for April, May, and June, or June, May, June, July, that kind of, you know, 3-month period of time, but then pay that back. Whatever you are owing to us, you pay it back over the next 6, 9, 12 months, some length of time there. So the benefit is you're working with the tenant, you're helping them out when they need it, they survive, they weather the storm, but you still collect back 100% of your rent. You just do it over a period of time. So that's why in August, we are expecting a number of kind of these rent deferrals to kick in so that we're going to over collect our rent because we're actually collecting back some of the stuff that should have been collected over April, May, and June. So, so it really is a deferral. So it's a receivables kind of challenge, but we're able to very well align the revenues and the expenses in our particular situation. And again, the same goes for this particular property. Of note, the tenant that is struggling is one of the smallest tenants in the property. They only account for about 7% of the square footage of this property. So even if that tenant doesn't survive and we're not able to collect rent from them, the property is still effectively operating with 93% rent collection. And as I mentioned, it's a strong rental market that we expect that if that did happen, we would be able to get that released in a reasonable amount of time. So why buy Millennium? I know I've got about, you know, if I take up the whole hour here, I've got about 10 minutes left. So I might start flying through a few slides here just to make sure I cover off all the major pieces that I want to talk about. But if you think again about the financial summary of what we're offering, it's a tax deduction in year 1. From year 2 to 14, it's about equity growth, right? We're bringing in that revenue, we're paying off the mortgage debt. To get us to year 15, we pay out the mortgage. Now it's about cash flow. Now, so you'll notice the open-ended arrow here. That's the point that I was making. It's not about the projects will never sell or will never exit or anything like that. It's just we want investors that want the cash flow from these, the long-term cash flow, because that's what we're designing it for. It's not like in year 15 things stop being exciting and we want to sell. Most of our investors are getting with this with that cash flow in mind, that it complements their retirement portfolio to provide that income stream year after year after year. So this current investment that we're looking at, it might go on 30 years, it might go on 50, it might go on 20, maybe 5 years in, we get a really impressive offer that somebody thinks there's diamonds under our buildings or something. Again, it's hypothetical, it's not happened, but you know, that's the kind of thing, is that a good offer is a good offer. If we ever get one, we will present it to investors and it's their choice of whether they want to sell the property or not. But going in, we do want investors that are expecting a long-term cash flow from this investment. And again, that happens to come with a nice upfront tax deduction as well. So who's typically buying? The age range that everybody kind of sees is that 45 to 55, right? It's investors that are in their higher income earning years and roughly 10 to 15 years away from retirement. So it kind of coincides really nicely. You buy the investment, you get the tax deduction, it helps your tax planning. And just as you're retiring, it starts to produce its cash flow. It works on both levels. What surprises a lot of people is that our second largest buying category is 60 plus. Now there's 2 different reasons. One is that often people that are, you know, right at the low end of that, 60, 61, 62, anywhere from 60 to 65, what they're doing is they're still maybe at their last few years of working or just recently retired, maybe they got a pension buyout. They are still doing some tax planning, but what they're also saying is, I know that this won't kick in until maybe I'm in my 70s, mid to late 70s, but I might need income until I'm 95 or 100. I have a grandmother, me personally speaking, that is 95. So that is potentially in my kind of, you know, genes in my blood, is that I might want to make sure I have a wealth plan that takes me well past my retirement. The other side of it, as I'd mentioned here, intergenerational wealth transfer, we do see that being part of the plan for these investors that are 60 plus. They say, well, you know, if I do pass away at say 70 or 75, or really at any point, I'm going to give this to my kids. I'll get the tax deduction, they'll get the long-term income stream if I don't, right? So just because somebody stops doesn't mean the investment does. So I think that's an important feature. And then of course there's the, you know, higher end degree of that is we get some people that are already 70, 75, that's exactly their plan. it's almost like a forced investment strategy for their kids, or in some cases grandkids, where the grandparents buy the investment, use the tax deduction, and then within the first 3 to 5 years, gift it to the kids and grandkids. It kind of has that better feel of, instead of just turning over $25,000 of cash to each kid or each grandkid, or knowing that when you pass away, your estate is going to give every kid a couple $100,000. A lot of our investors like the fact that prior to them passing away, they can start to transfer their wealth, and it's wealth that isn't easily liquid, that the kids can just sell it and go to Las Vegas and bet it all on black or something like that, right? It's kind of, it's transferable wealth that has that ability to be intergenerational. The last age category is just a little bit younger, 35 to 40. There's a lot more young professionals that are buying. I'm actually in this category. I'm 38, as I mentioned in the presentation, whereas I've got a little guy who's 2.5. I'm going to buy an investment, and by the time it starts to produce its cash flow, he'll probably be just starting up his university. I can use this to kind of help fund that. I will find ways to use the income stream from these investments before I retire, and my little guy is probably going to be a big part of that. So there is that kind of younger demographic that is able to purchase units as well. So again, with tax changes, whether you're the high tax bracket, which keeps getting higher, perhaps you did income sprinkling before, that's kind of done away with. If you're looking at investments within a corporation and you are kind of those TOSI rules where you're looking at how much passive income that you have, we can help with that. We can help reduce those tax bills in pretty much any facet that they come. So again, here's just a quick example. Somebody that has $150,000 taxable income, they buy 2 units. It reduces their taxable income to $126,000, works with employment income, capital gain dividend, all sorts of things like that. The next is that retirement standards are getting higher. So again, if anybody is 65 years old on the call today, according to Statistics Canada, your life expectancy is 86. That's how long you're going to live. But what they don't tell you is some people pass away earlier, some people pass away later. So for everybody that passes at 75, somebody else is living to 95, right? So it's that kind of bell curve model that, you might need income producing assets for many, many years after you retire in the 60, 65 range, right? In fact, JP Morgan's did a study that said, if both spouses are 65, there's a 47% chance one of them lives to 90. So you really want to make sure that you're accounting for that. You're building income producing assets that will continue and grow and hedge inflation. And this is one way that Millennium 3 can help. Okay, just again, another one showing life expectancies. And the final thing that I'll mention is, again, just kind of how there's been shift at large financial institutions and whatnot of shifting money away from just the public markets. As I'm for sure everyone knows, markets can be volatile. What Trump does one day affects the market the next day. There's all sorts of kind of sentiments that kind of help change things, that the fundamentals of a business might not change, but just the fact that it's publicly traded can send its stock price kind of swinging good or bad. And unless you're an expert in that, your investment portfolio can go with it. So in the last number of years, Harvard, Yale, OMERS, even the CPP has started to invest a lot more into real estate and real assets. So just a couple slides here. This is one, for example, that their average hold period expected for core real estate, which is the category that we would fit into, is about 17 years. So that's kind of what the Millennium 3 business model offers. So the last 2 pieces, this is my contact information. I'll maybe come back to this slide because I did want to touch on just the returns of a couple things, right? So projects that have sold. So since 1995, when we switched to that kind of earlier model, 6 properties have sold. This is to the year end 2017. Now, the 6 that have sold, Baltimore, Grenville, Russell, this is just the kind of names of them. I apologize here. I'm just kind of doing a quick scan. The rates have been between 200% and 400% with an average of about 300. So if you think about it, the investment dollars going in, but you get your tax deduction, we're assuming a highest marginal tax rate in Saskatchewan for these investments. The after-tax cost is really what somebody has left in the investment, right? So if you invest $25,000, you get a $12,000 tax deduction, you get $400 a year for a few years. Kind of what you have left on the table, so to speak, ends up being typically between $10,000 and $12,500, $13,000. So these exits provided exits of $50,000, $52,000, $77,000, $40,000, $46,000, and $80,000. So they're not all kind of hitting out of the park. Sometimes it's maybe more of a doubling of money or in this case it's a quadruple of their after-tax cost, but closer to a double of what they put in. But that's really the idea, is that an exit is an exit. Investors get to vote and decide if they want it. Sometimes it's fantastic. Sometimes it's, 77,000 over, 10 years. Sometimes it's 50,000 over 7 years. This one was a little bit longer. It was 21 years, but it was $82,000. So when an exit opportunity presents itself, it's proposed to investors. It's their choice. Now, there has been about 60 properties that we've syndicated since 1995. So this is only kind of 10%. So if an opportunity presents itself, we will propose it. But what you should more be accounting for and expecting is a long-term revenue producer. What is the ROI? How has it been returning investment? So this is what we looked at. So there was 16 mature properties. So what that means is it's had its 15 years to pay out its mortgage. Now what is it doing, right? So we've looked at those properties and kind of how they've gone and what they've done. Now there's 16 of them. It turns out that if you bought one of each of them, the average rate of return is 16.16%. So it's really easy for me to remember. It's very much a coincidence that it's worked out that way, but that is the truth. Now it's a simple after-tax rate of return, but keep in mind, we are counting the after-tax rate of return, assuming the highest marginal tax rate in Saskatchewan. So we are counting the tax savings at the front end, but we are also counting the tax paid at the back end. If things go according to plan and this pays out $5,000 at the end, at some point, it's $5,000 of taxable income. Like the government always wants their share. So keep that in mind, we're not cherry picking information. It is counting taxes at the front end and at the back end, savings and paid. But nonetheless, this is the after-tax rate of return. The median of those 16 is about 13.67%, the high of 30 and the low of 5. So even the projects that haven't worked out the way we expected have produced positive returns for investors. They don't all work out. That's why we encourage diversification. There's things that end up being kind of out of our control with city planning and all sorts of different kind of things. But generally speaking, as I mentioned really early in the presentation, we don't have a crystal ball, but we do have a lot of years of experience. So that's what we're relying on to make these projections, to bring these offerings to investors, and taking that ride with you together into the future. So what I'll do is I'll just flip back here to my contact information if anybody wants it. Gerald at Millennium 3, Gerald with a J, Millennium is 2 L's, 2 N's. I can field any questions here. I'm going to pop into the Q&A to see what's available, or maybe I'll just turn it back to Adam. That's myself, the website there. It's very informative. It's a little bit, older on design and whatnot, but it's very informative from an information perspective. So feel free to go there as well.
Gerald, the first question I've got is, if somebody wants to do have a call with you specifically to talk about the tax advantages that may apply directly to them, you're happy to take that call?
Absolutely. I'm by no means a tax expert, but I've done this a lot. Sorry, I just switched slides there. And we're more than willing to help there. Everybody's tax situation is different. How you get paid, where it's coming from, is it a capital gain? We can help with all that kind of stuff. We've even if necessary, I can get our vice president of accounting on the call. He helps me out maybe 4 to 6 times a year with clients that have really unique tax situations. There isn't much that he hasn't seen and he can't kind of help us get through. And at the end of the day, it's just helping you find, will this work for you or not? And if it does, we're happy to try to help find that path. So definitely take down the information if that is your particular circumstance.
Sure. Okay. Gerald, do you budget for major R&M? I'm assuming that stands for renovations and maintenance. Will partners be responsible for funding large R&M that was unforeseen or not budgeted for?
Two-part answer. The bigger kind of R&M repair and maintenance in the early years, that's all accounted for in the partnership. So whatever we want to do to the property at the beginning, that's definitely accounted for. So a good example of this down the road is a roof. What happens when the roof goes, they're a larger capital outlay. It's usually pretty expensive. What happens? Now, most things are paid for by the tenants. It's, again, one of the unique pieces of commercial real estate is you as a landlord are responsible for the exterior walls, the roof, and the foundation, but most other things you can bill back to tenants. So if a tenant calls you in the middle of the night, the furnace goes out, we will go and do the work, but guess who's getting the bill? It's the tenants, right? So there's a lot of that kind of ongoing repair and maintenance is generally considered a recoverable expense from tenants. But, that's the idea, is that most of that will get paid by the tenants. The roof example that I gave, that does come out of partnership revenue. So in cases where a roof comes up, a roof life is anywhere between 20 and 40 years, depending on the type of roof and newer technologies and things like that. So what we do is we typically account for that. If we know that we've got 5 or 10 years left on the roof, we might start to budget for that, start to defer a little bit of revenue towards that. And at some point when that roof expense comes, it does come out of partnership revenues. I am very pleased to say that partners themselves have not been responsible to pay for those expenses in all of the 18 years that I've been with the company. We've never done a cash call. So that is, to me, I'm very happy to pass that along, that the partnership will effectively have to pay for some expenses, and the roof is one that does come up. But we budget for it, we account for it, we see it coming and pay for it out of revenue or other sort of sources if necessary. That it's definitely not partners coming out of pocket to pay for that.
That's great. What's the liquidity option for a client that wants or needs to get out? Right. I mean, this is a longer hold.
Yep.
And sometimes life happens, right? So a client this might be a suitable investment for them today, but 7 years from now, maybe their life has changed in a meaningful way, and they need to get out. How does that work?
Yeah, so what that generally looks like, as exactly you have it, life does change. So the piece of that liquidity that we can provide for investors, it's not an official secondary market, but there are a number of investors that we know that are often interested in the cash flow of the investment and less about the tax deduction, right? Especially those older investors. Somebody at 60, the number one thing I hear almost every time is, I wish I'd found this 5 years ago, 8 years ago, 10 years ago, right? So often what will happen is somebody wants to get out for whatever reason. We explain to them, this is how it works. What we end up doing is we do kind of a basic valuation of their investment unit. We give them what we feel is a fair high, medium, and low value. The investor then sets the reserve bid, right? So then what we do is we send out a letter to the other investors in the partnership that says, dear investors, somebody wants to get out. It's done anonymously, but here's what they want as the minimum amount they'll take. And it's a blind tender from that point. So that's been very successful in finding that. And what we're really doing is just connecting investors in the same partnership that somebody wants to get out and somebody says, I would take a little bit more of that if it was available, right? So it's not, the catch-22 is, it's not an official secondary market. So it's not like public stocks where there is always a buyer and always a seller. Now, the one thing that I like to point out to people is, much like life changed potentially for an investor after 7 or 10 years or whatever the case is, things can also adapt within our investment model. There's been things that we've looked at in the past that have been talked about that maybe there'll be a secondary market for stuff like this. Maybe there'll be a fund of just Millennium exits for investors that new investors can kind of populate and get into. So there are lots of things that could change in this investment, but as of now, that's a system that we have, and that's a system that actually works fairly well. It's just still something that has to be adjusted and managed for. It's certainly not guaranteed.
Okay, that's great.
Awesome.
Let's read this next one as written. Wow, I am very impressed with the financial planning aspects of this investment. I've been in LPs before, but I can see the benefits of this unique opportunity. Thank you for a most informative presentation. I'd love to see a lifetime example cash flow analysis with annualized returns, if that is possible, including a real estate appreciation in the calculation. Second part, will you make this slide deck available?
The slide deck, I certainly can. I can forward that to Raintree, and they can follow up, or you can get in touch with me directly if you'd like to. As far as the lifetime cash flows, it becomes a little bit of a challenge, and the reason is privacy. So there is privacy restrictions on all active LPs that have publicly available information is only available to. Sorry, I take that back already. It's not publicly available information. information about the partnership is only available to the partners in that partnership. So some of the information that I've shown is an aggregate of that. So that's why we're talking about the best, the worst, the average, all that kind of stuff. So I can certainly dig into this, with an investor or two if they want to kind of drill in a little bit further, but I can't forward information on active partnerships. It just has a trickle down that can violate some privacy stuff that we really have to be cautious of. In this day and age, that sort of thing is something you have to be very, very conscious of. Non-active LPs, sorry, I see a follow-up kind of question here. The ones that have sold, I can certainly have a little bit of a bigger dive into if somebody would so like. The only thing that I have to point out there as well is non-active LPs are LPs where there's been an exit, right? So some of them, they were sold before they ever get to the cash flow portion of the investment. So it might not be exactly what you're looking for, but certainly, that's the type of thing that I can dig into with a client if they so wish. So feel free to just get in touch and we'll see how we can connect that.
Yeah, that was going to be my recommendation. The gentleman asking these questions, I would just recommend reaching out directly to Gerald and or maybe make sure you CC whichever Raintree advisor invited you to the call, and we'll get you what you need. Gerald, this is a great call as usual. Love the way you approach this stuff. Did a great job as always. So, and for all those who chose to invest a little bit of your valuable time with us today, we are grateful for that. I hope everybody's having a good and safe day. Enjoy the rest of it and the rest of your week as well. Thanks, everyone. Have a great day.
Thanks a lot. Take care.